going because there's probably a bit to get through this morning. So I've got a little bit of news to cover, and then we'll be talking to Andrew McHattie, who's going to run over what happened over the course of September. And then our guest this week is Masaki Takatsumi of Schroders Japan Growth. So we'll be finding out what's driving that fund's performance. So in terms of what I thought we'd cover in the news, Bluefield Solar has just announced results, and I thought we'd go into those because they're quite illustrative of some other things that are going on. Then I want to look at what's going on with some share prices in alternative assets, and I think it's related to discount rates. And then just briefly what's going on with the 3 IPOs that we've got running the books at the moment. So Bluefield Solar first, as we can see here, the NAV has been marching up, really accelerating recently, but the share price has gone the other way just in the last week or so, to the point it's now gone back on a discount again. The results, we knew the NAV already, but it's still pretty impressive. It's 140p up from 115, which gives you an NAV total return for the year of 28%, just to the end of June. Shareholders made 14.5% because the premium reduced a bit. The dividend was higher than the target. What they haven't done so far is set what the dividend is going to be for next year, and there's a good reason for that, I think. It was extremely well covered by underlying earnings. That's taking the earnings per share, taking off the moves in valuations and adjusting for the amortization of debt. So that now means they've got revenue reserves built up of about 3.4p, which is obviously helpful in before whatever happens in the future. It's doing its job in terms of generating renewable power, ticks all the right boxes in terms of saving CO2. One of the things I thought we should mention there, point, is that 57% of revenues now are index linked to inflation. And that's down on where it was because it's been buying things that aren't necessarily linked to inflation, but they are remunerated in different ways. But it's got very good revenue visibility, as we'll explain in a second, which I think is going to affect what we can have with the dividend. It's got bigger, so it raised 255 million in the course of the accounting year, and went into the FTSE 250 index. I think that's probably unhelpful, and it's unhelpful because investors have been shorting the FTSE 250 index as a way of selling the UK on the back of what's going on with our economy. So I think that's one of the reasons why its share price is going down. It obviously made its first wind investment during the year. We've talked about that before. We've also talked about the new solar plants that it's building under the new subsidy regime, where it gets paid a fixed price for the power it produces, which is index linked to inflation measured by CPI. And it's got a big pipeline, so it does want to carry on going. 1.1 gigawatts is really quite significant. In terms of leverage, I think this is important to have a look at because obviously with interest rates going up, the degree to which your interest rates aren't fixed is going to make quite a big difference to some funds. Fortunately, with Bluefield, they have fixed most of theirs. They also did this thing that I didn't understand at the time, where they basically took a 3-year loan and then hedged it until 2037. That's obviously paying off big time. So we'll see in a minute how that works out in practice. In terms of the valuation, they did increase their discount rate. So the NAV is valued on discounted cash flow basis, and they dragged it down by raising the discount up to reflect the higher interest rates. The other thing that changes it is the putting wind into the portfolio, because there are different risks associated with wind than there are with solar, and that the risk premium that you pay for wind is different to the risk premium you pay for solar. But everything's sort of informed by, works back to what price things are changing hands at in the secondary market. So they're saying that they're seeing things go through at about 1.4 million a megawatt. And so they valued their portfolio at about 1.38, so just below that. I think That's an important thing. We'll come to talk about discount rates in a minute. It's important to remember. Inflation is obviously going up a lot. These are the assumptions that are used in the NAV. So that 10.9% in 2022 is looking slightly light at the moment because it was 12.3 at the end of August. We won't see what happens at the end of September. But they are assuming it falls off quite sharply thereafter. And obviously that might not happen. We'll have to wait and see what the economic fallout is from what's been going on. But the higher power prices are what's driving the big difference. And they're locking these in with power purchase agreements, PPAs. So these are the ones that they had for June 22. And you can see that there's a big spike for ones in January 23. £303 a megawatt hour is actually quite high, actually even relative to where power prices are today. And they're still pretty high, running all the way throughout to June 24. That's obviously not covering all of their output, but nevertheless, that's good. This is what I meant about having good visibility of their income. They can see what's going on. And then this is probably this one, the next slide, are probably the sort of two really interesting slides here, because this is the sensitivity of the NAV to moves in various assumptions. So it changed the discount rate, moves the NAV by about 3.6, 3.7p, depending on which way you're going. Power prices, that's a 10% move. Inflation, energy yields, that doesn't tend to change very much. Actually, the solar irradiation was a bit higher than forecast this year. And the operational costs, which are obviously slightly impacted by inflation too, that is another factor. But what they did was, on the back of the mini budget, they said, well, this is what we think the actual impact may be to the NAV. Obviously, this is just a sort of slightly finger in the air. We have to caveat this heavily because we won't know really what the end of September NAV is for some time yet. But they're saying inflation might have added another 2.5p to the NAV. The interest rate going up might have taken about 0.4 off. The tax rate change, which is something that we've highlighted last week, where the corporation tax is 19%, that's a big positive impact. So it adds about 5.3p. And then if you add 1.5% to the discount rate, that takes off about 10.8p. So the net of all of that is that the NAV might fall by 3.6, which from 140, given that where we were 115, 116 last year, is not very much at all. And so therefore suggests that the share price move might be a bit of an overreaction. And actually, if you look at Bluefield's share price today, it is up quite strongly. Now, I'm being informed by one of our viewers that the BSIF has set dividend target as 8.4p. I have not seen that anywhere, so thanks for spotting that. But that's obviously quite good news if that's true. That's just much higher than where we are now. Now, discount rates. As we've explained with Bluefield already, so most of these alternative asset classes are valued on discounted cash flows. And the way that net initial yields work in the property sector is kind of similar. As we've seen already, there are lots of different moving parts that make up the NAV, including the discount rates. It's not just a single thing. The discount rate should be the rate of the risk-free asset, which is the government bond, equivalent government bond, plus a risk margin. And that risk margin should be determined by how much debt the asset's got, how volatile its earnings are, all those sorts of factors. But the big thing that's impacting it in solar and wind is what price things are changing at the secondary market. So if things are changing hands at 1.4 million, then that kind of works back to, well, that must mean that the risk-free, or the risk premium is X to give you the gap between the two. It's a very inexact science. It's probably slightly more art than science. The big component move obviously been what's been going on with long-dated gilt yields since the mini budget. So they spiked up. They went over 5 very briefly, but they're back down now since the Bank of England intervened. But they're still way higher than they were even 10 years ago. So not great. And you would think that that would mean the discount rates will go up by a chunk. This is what's happened to the renewable sector. So I've basically done a few of these charts. You can see now that most things now are trading at a discount. Yields have also gone up, so compensate at 5.4. I think these discounts are maybe a bit too big, is what we're saying. Here we are. Normally we show you the long-term share price NAV moves. These are the short-term ones. So you can see the NAVs haven't much moved yet, obviously, because these things are obviously in a lag. We won't know what the end of September NAVs are probably until November, towards the back end of the year. But this is what the share price moves have done. They're not in any order, but it does look like they're sort of working alphabetical order. I don't know why that was. The big move in here, STL energy efficiency, I don't understand that one at all. Well, actually, as you'll see in a bit, we've got them coming on the show in a couple of weeks' time again, so we can find out what they think about that. And I think hopefully things might move by that. Another one is JLEN. We published a note on them yesterday. Do have a read of that. I don't agree with it, with that share price move at all. In infrastructure, same thing. So we've got average discount there of 7.8. That's obviously skewed by the awful thing that is infrastructure India, but still, even then, things have definitely widened out. And the other ones that have really moved are the two royalties funds. So Hypnosis and Roundhill. They've just dived off a cliff. And you can see that here in the share price moves. So an average of 8 out there, down there, 21.2 drop for Hypnosis. So I think, and there's a reason I want to link these two stories together. I think what we've seen is already that there's a relationship between discount rates and interest rates is not linear because there's flexibility in the risk premium. I've written an article for Citywire that kind of explains it a bit more, so you'll see that next week. Looking at the experience of HICL over time, its discount rate hasn't much changed from when it launched in 2006-07 to today. Really, it's always been roughly about sort of 7%ish, but the makeup of its portfolio has changed. Also worth remembering that not everything in these sectors is priced off UK gilts. A lot of it is actually now overseas. A lot of it's European. Some of it's Asia as well now. Some of it's US. For the royalties funds, it is worth remembering that they are mostly dollar earners, and most of their income is from US customers. But US long bonds have increased as well, so that it is right that the discount rate might have moved up. And there's a particular problem that Hypnosis has got in that it might, if its NAV dropped, breach its debt covenant. And that, I think, is probably why their share price is so weak. And as I said, Bluefield Solar's up this morning, just reflecting that people aren't maybe as worried about it as they maybe were. Lastly, for me, there were 3 IPOs on the go. The Welkin China has said that give us another month. We think we're going to get there. Independent Living REIT pulled out its IPO this morning. In theory, it's still around. I've never seen. I don't know. Maybe there's an occasion where somebody did that and it did come back later on. We'll have to wait and see on that one. The Sustainable Farmland one, we won't know until, I think, Monday after next, because the applications close on Friday next week. So we'll see whether that happens or not. Anyway, that's enough from me. Let's now hand over to Andrew.
Lovely. Thank you very much indeed, James. And just while I'm switching over to my other screen, I can just say that actually Hypnosis Songs Fund did come to the market at the second time of asking. So
okay, right, there we go, that's it.
So very occasionally it happens, but you're right, it's a rare thing, and obviously yeah, very tough environment at the moment for fundraising. It's quite interesting as well that Harmony Energy is trying to raise money through a C share issue at the moment, when its shares are on a big discount to NAV ordinary shares. So that's a bit of a tough one. Anyway, let's have a look and see what's happened in these tricky market conditions. There have been a few gains, actually. There always are, because of course it's a very diverse sector that we look at here. There's a unifying theme amongst most of these, actually. Clearly some special situations, like Fund Smith Emerging Equities Trust, which is winding up. But the key thing that most of these risers have in common is that all of those in blue here are dollar denominated. So in order to rise in sterling terms, they didn't need to do anything. They just needed to sit there and be in dollars. And the one in green there is euro denominated, the Chanavari Trust. So effectively, obviously, it has paid to own overseas assets at this time. And historically, actually, times of falling sterling have been quite good for the investment company sector, because obviously a lot of the assets are dollar based, even if they're not dollar denominated. And there's a lot of overseas exposure, even in the UK trusts, in UK equity income exposure is often actually quite international. So anyway, that's the unifying theme amongst the risers, and there's not too much else to say about those. Quite naturally, this month, we'll talk about the fallers much more. But just before I leave the currency, I was talking to a friend last night who said he could remember the pound over 250 against the dollar, which says something about his age, because that was back in the 1970s. But when I looked at the long-term chart, you can see this does go back to 1970 here. What I found interesting was that we did have this dip before, actually in 1985, where sterling reached roughly the same levels as it so happens that it's at now. And I just looked into a bit of the history as to why that was. Actually, it wasn't very much to do with sterling. It was really more to do with the dollar strength. And ironically enough, the dollar was incredibly strong because Ronald Reagan was busy cutting taxes. And so it was almost the inverse to what's happening to us now. So in that circumstance, the US economy really was buoyed hugely by that. And the Federal Reserve had to step in and cool it down with rising interest rates, hence the strength of the dollar. Anyway, that's just a reminder, I think, that actually, although this all seems very fresh and new and dramatic, the currency markets have seen it all before, and we'll see what happens next. It's pretty difficult to forecast, I would say. So the falls over the month, again, there's very much a unifying theme amongst these. They're clearly a little out of date because I did this yesterday, but property has effectively been the hardest hit sector. And it's been a pretty broad sweep down, actually. Many trusts there have come down almost regardless, I think, of their quality. And I'll talk about why that is. There are a few others in there, like Reverend Mercantile UK Micro Cap, which, again, is perhaps understandable that sector has dropped, although the Miton one actually has held up incredibly well, maybe a bit too well. But clearly, real estate is the main story here. And effectively, this is the sector that is most sensitive to interest rates. And one of those factors is that property is effectively price of yields. So, when you talk to managers who are actively dealing in the property market, I don't think I've ever heard them tell me about the price when they bought something. They always talk about the yield. They say, I bought it on a 7.2 yield or whatever it is. And therefore, the whole industry is based on yields. So if the required yields are on the rise because of generally rising interest rates, then property prices need to fall. And I think that factor has been most significant for a number of trusts, particularly those in the logistics subsector, where the yields were comparatively low prior to this recent period because of the underlying tailwinds that were increasing demand in that sector. And now that the required yields have risen, people are focusing on that, and the logistics sector has been very hard hit. But there are other factors as well at play here. So certainly future debt finance, and debt finance plays a crucial role in pretty much every REIT, that could become more expensive. And I do think that means if you're looking at trusts in the sector now, it's quite important to look at loan to value and on when the debt is falling due, because this could be a spike, and we might well see rates fall back again. So for trusts that have decent debt structures where they're not needing to renew any of their debt for a couple of years, then you may find they actually avoid that issue. And the third thing is that at the present time, whenever I talk to real estate managers, they all tell me that they're having no difficulty with rents and that tenants are paying, and actually the post-pandemic recovery in rent collection has been very, very good. But clearly, if there is a recession and certain sectors begin to struggle, then there could be future difficulties with rental collections. So taken as a whole, rising interest rates do spell a whole lot of potential trouble for the real estate sector. But I think there's also, a great deal of sentiment at play here. And that's a big issue, that effectively, I think there's been quite a lot of indiscriminate selling, even though some of the trusts actually seem quite well positioned, even when you take into account those factors we've been talking about. A lot of the yields available now have sprinted northwards. For many years, actually, I saw a typical yield available from a property investment trust tended to average around 4 or 5%. Now there's quite a lot around 7%. So there's some very good yields available. And the discounts to NAV, obviously based on historic NAVs, are really quite astonishingly wide in some cases. 40 to 50% is not uncommon amongst the diversified property trusts. So a lot of these potential difficulties are clearly in the price already. So I think for investors looking to lock in high yields, there's some opportunity here. And you can perhaps think, well, even if some of the dividends might be trimmed a little bit, if there are rent collection problems in the future, still the yields can be quite reasonable. And I think actually right across the sectors, there's a whole bunch of interesting opportunities here. I could have picked out 15 of these, obviously that would take too long. So a quick word about 4. Just one of the mainstream ones that I've been following for years is Aberdeen Property Income Trust. That was the old Standard Life Income Property Trust, SLIPIT as it was known. So yesterday, this was yielding 6.7%. That's just down a bit to 6.4 this morning. It's almost a 50% discount to NAV. And that seems to be pretty wide to me in view of the experienced manager who was ready for this market dislocation and talked about it a month ago and said, he was quite looking forward to the chance to pick up a few properties a bit more cheaply. It's diversified, the trust is buying back shares. I think that's quite a solid trust to think about. The next one on the list, Phoenix Spree Deutschland, fell out of favor really because it's in Germany. It's Berlin property, and Germany is seen as being under great pressure, particularly in relation to energy. But again here, you've got a very big discount, and the trust has just announced its results, which showed a rising NAV. The loan to value looks reasonable. Importantly here, it has no loans maturing until 2026, so there's a bit of time for it there to see things moderate. The yield's not the story on that one, it's quite low, but nevertheless, I think the discount is perhaps an opportunity there. Regional REIT is a particularly curious one because its focus on offices has led to really heavy pessimism in the market about its prospects. Again, the yield was 11.4% yesterday. The shares are up 6% today, so that's come down a bit to 10.4 now. But you're getting a double-digit yield there. And I spoke to the managers actually last week, and the feedback I've been getting from them is consistently completely at odds from everything you read in the newspapers about exactly what's happening with the return to work. And they say actually most of their tenants are returning to the office, that the pendulum has swung a little bit towards the businesses there, away from the employees, which was something a Manpower survey also said last week. So there's quite a lot, and the dividend is covered there. So there's a lot of positives. One interesting negative, which I hadn't really ever thought about before, is that the landlord, because they have some vacant properties, they're finding that energy prices are biting a bit and eating into their income, because you can't just switch the power off when your building is empty. You have to maintain some heat and lighting, and many of these buildings are multi-let. So again, you can't just switch things off. So that's something to think about. But again, hopefully the energy price spike will be temporary. The last one here is Impact Healthcare REITs, which I've always considered to be a very well-managed and conservative trust. Actually, it's care homes. It has, fine demographic tailwind. It's always collected all of its rents. It's in a strong liquidity position because it's just raised some money. And again, the yield there, 6.6%, which I think is rather high, I think, for the kind of position it's in. So lots of opportunities there. And I also just want to touch on Tritax Big Box REIT, because I talked about this a month ago. And I asked the question at that time as to whether the pendulum has swung too far on the big move from a premium to a discount. I felt it probably had, which was clearly wrong. I anticipated that far too soon. Again, you see here that just how much the discount has widened out, this chart at the bottom here. Again, it's approaching 50%. So a lot of bad news is really in the price there. And we may find that the market is overreacting. I do think, the yield today is 5.2% on that, which seems to me a pretty good return on something which does have such structural strength. Clearly, it could be at risk in a recession, but when you look at the size of its tenant base, I think they're quite strong. The risk here is probably in the development, which the trust is undertaking. Nevertheless, for me, the risk-reward balance is quite attractive now. And my last slide here is just about the yield opportunities which have arisen across the market, really, because of this big, broad sell-off, which has seen the whole sector come down by about 6% this month. There are three areas here. The first is lending trusts, so credit trusts. The yields here are very high, so 9 to 11%. And I think there is a risk here, clearly, that in a recessionary environment, some of the loans don't get repaid. But there are some interesting valuation wrinkles when you look into these trusts. A couple of them, so VPC Specialty Lending and Riverstone Credit, they both have quite interesting return of capital arrangements coming up, which should enable you to come out, or at least partially, next year or the year after, at NAV, whereas they're on a discount. So you've got a potential capital uplift on some of these while you're being paid 9 or 10% to wait. So, interesting, worth looking into, although they're quite complex. So you need to be careful with your analysis on those. I won't say too much about infrastructure and renewables because James has just covered that in comprehensive detail. I'll just add actually that I spoke to James Armstrong of Bluefield this morning, and he was very confident about the future of the dividend and the income flows. And he's always said to me over the years that I shouldn't be looking at the NAV because that is subject to so many factors that are pushing and pulling it in different directions. And it's really about cash generation and dividend growth. And he's very, very confident on that, to the extent that when I asked about the difficulties of future fundraising, he said, well, of course, we will have some spare cash, from our income flows. So we can actually pre-fund some of our own developments that way. So again, if you're looking at a decent, 6.5% yield there, without quite as much risk as maybe built into the current price, I think it's potentially a good opportunity. And then the last segment here is equity trusts, which we shouldn't overlook because they don't have quite the same exciting narrative as some of the alternative asset trusts. But actually, again, some of the yields have come up as the market's fallen. Roughly 5 to 7%, I'd say, is available at the top end from things like City of London Merchants, CT UK High Income. BlackRock World Mining is on the list here, but that one's slightly different because that doesn't have a progressive dividend policy. It just pays out whatever income it has. And I suspect this year that will be a bit lower than last year. So there could be a dividend cut there. And then you've got Henderson Far East Income finally as an outlier there, which has a very high dividend yield, which again looks as though it's going to be maintained. So I think right now in the market, whilst the price movements are quite volatile and a little bit scary, actually there's a lot of opportunity being thrown up. And if you are a yield investor, I think you can lock in a lot of good value at this time. So it's interesting right across a whole number of sectors. So I'll leave those thoughts with you without going into any specific recommendations, and hand you back to James to have a chat about something different.
Great, thanks so much, Andrew. We're definitely living in interesting times, I think.
Yeah.
Good. Now, let's move on.